Welcome back to Talk Tickers. Today we're jumping right into the latest earnings call from TSAIC as for their first quarter of 2025.
That's right. And we're here to sort of unpack the key numbers and figure out what it all means.
So the headline, how did they actually do?
Well, the headline is pretty positive, actually. Q1 came in better than expected.
Okay.
Earnings per share were 83 cents, and that was on sales of about $1.22 billion.
And return on invested capital. I saw that number too.
Yep, a healthy 15% ROIC. So solid on that front.
Okay, but it wasn't all smooth sailing, right? I saw operating margins in aerials and MP were a bit lower.
Yeah, that's true. That was kind of expected, though, because they'd cut production earlier to manage inventory levels. They are expecting improvement there in Q2.
Gotcha. But the environmental solutions side looks strong.
Oh, definitely. Environmental solutions, which, includes ESG and Terra utilities, really performed well.
Oh, wow.
Pulled in about a third of their total global sales. And the operating margin there was 19.4%.
Yeah.
Really impressive.
Wow. Okay. So that's becoming a bigger piece of the pie for them.
Exactly. And despite all this, and even factoring in potential tariff impacts, they're holding their full year guidance.
Which was?
Remind me. They're sticking with the $4.70 to $5.10 EPS range for the full year.
Okay. Even with tariffs, that's confident.
It is. Now, they do still see full year sales being lower year over year in aerials and MPs.
But environmental solutions?
That outlook actually improved slightly. They're now expecting slightly better growth there than before.
Right. Let's dig a bit deeper then. That $1.2 billion in net sales, how does that compare year over year?
It was down 4.9%. If you look at constant currency, it's down about 3.6%.
Okay.
And if you strip out the environmental solutions group, the sort of organic sales decline was about 2.5%.
But you mentioned orders looked good.
Yeah, the book-to-bill ratio was really strong, came in at 124%.
And that's the second quarter in a row for that.
Exactly. Suggests, pretty robust underlying demand. And because of that, the backlog grew too. It's up to $2.6 billion now. That's a 13% jump just from the previous quarter.
Okay, that's a significant backlog. Now, what about that overall operating margin? 9.1%, you said?
Yeah, 9.1%. It's lower than last year, yes, but it is showing some sequential improvement from Q4 of 2024.
But again, if we exclude ESG.
Yeah, excluding ESG, the organic operating margin decline was more significant, mostly due to lower volume in those other segments, aerials and MP.
Right. And interest expense was up.
It was up to $41 million. That's mainly the financing costs tied to that big ESG acquisition they made.
Makes sense. But free cash flow improved. How does that work with lower earnings?
Better working capital management. They were more efficient there, which helped offset the lower earnings impact on cash flow.
Okay. And you touched on this earlier, but the factory under absorption, that hit earnings pretty hard.
It did. About 31 cents per share impact, primarily from those production cuts in aerials and MP. When you're not running the factory's full tilt, those fixed costs still weigh on you.
Right. Okay, let's break down the segments then. Aerials first. $450 million in sales.
Yep, pretty much right on their expectations. And interestingly, about half of those sales landed right in March. Seemed driven by rental customers.
And the margin there was only 3%.
Yeah, 3%, down year over year, like we said, but it was slightly up from Q4.
And they expect that to improve quickly.
Very quickly. They're forecasting a return to double-digit operating margins in Q2 as they ramp production back up.
Okay, that's a key thing to watch. What about materials processing, or MP?
MP had sales of $382 million, also basically in line with their plan.
What are the dynamics there?
Well, in the U.S., equipment utilization is high, quote, activity is positive, and dealer stock levels are slowly coming down. So some good signs.
But there's always a but.
Right. But macro uncertainty, interest rates, it's still making it tough for customers to make that leap from renting to actually buying.
And Europe.
Still weak, particularly for MP.
Any bright spots within MP?
Yeah, the concrete business actually showed better margins. And overall, MP did manage to stay in double-digit margins thanks to cost cuts.
And the outlook for MP margins?
They expect sequential improvement through the year. Q1 should be the low point for margins in that segment.
Okay. And now the star performer, environmental solutions.
Absolutely the standout. Around $400 million in sales, like we said, a third of the total. Record sales, record shipments.
And that 19.4% margin. Sustainable.
Well, it reflects strong performance in Terra utilities and really significant improvement at ESG. They expect margins to stay strong, but maybe moderate just a little bit going forward. Can't always stay quite that high,
Understood. Okay, let's pivot to the elephant in the room. Tariffs. How are they managing that 40-cent predicted impact?
Well, first, that 40-cent estimate includes an assumption that some current rates might ease up a bit later.
Okay, so it's not worst-case scenario baked in.
Right. And they've been proactive. They've forward-placed inventory, worked with suppliers to share the burden.
And pricing.
The goal is price-cost neutrality. So trying to pass it through without hurting competitiveness. They are using surcharges in some areas.
And domestic production helps here, I assume.
Big time. They expect about 75% of their 2025 U.S. machine sales will actually be built in the U.S.
Where specifically?
A lot of the Genie stuff comes out of Washington State. And the Terex handlers they bring in from Mexico, those qualify under USMCA, so they're currently exempt from these specific tariffs.
What about other international production?
Their main aggregates lines are built in Northern Ireland in the UK. They don't really expect those to get caught up in long-term trade actions.
So where's the main tariff pinch point then?
It's mostly going to be on raw materials coming from China. That primarily hits the aerial segment.
Kind of timing.
Mainly Q3 is where they expect the biggest hit, with some impact also in Q2 and Q4. And again, the outlook kind of hopes for some de-escalation with China tariffs.
Okay, shifting to strategy. They're sticking with their execute, innovate, and grow plan.
Yep. No change there. And the ESG integration seems to be going well. They're targeting over $25 million in annual cost savings, those run rate synergies, by the end of 2026.
Are they looking at other cost savings?
They are. They mentioned evaluating their whole global footprint factories, operations, looking for ways to trim fixed costs and just get more efficient.
Plus investments in new stuff.
Right. New products, digital solutions. And they see ESG as a really key part of their organic growth story moving forward. They talked about a $40 billion addressable market with a lot of upside.
Financially, what's the plan? Strong liquidity.
Expecting strong liquidity, yeah.
Yeah.
And they plan to pay down some debt, deleverage in the second half of the year.
And capital allocation. Buybacks, dividends.
Priorities remain the same there. Returning capital to shareholders is still part of the plan.
How are bookings and backlog trends looking now?
They seem to have returned to more normal seasonal patterns. Aerials saw strong bookings, mostly replacement demand from rental companies.
And
MP backlog was up sequentially. Environmental solutions backlog also remains quite strong.
so looking ahead, quarter by quarter, Q2 and Q3 should be the stronger earnings periods.
That's the expectation, yes. Stronger than Q1 and Q4. And they're also forecasting a pretty significant jump in free cash flow for the full year 2025.
Okay, let's recap the segment outlooks. Aerials.
Maintaining the expectation of sales down low double digits for the year, but confident in that return to double-digit margins starting in Q2.
Materials processing.
Still expecting sales down high single digits. And again, Q1 was likely the trough for margins there.
And environmental solutions.
They actually increased the full-year sales outlook there, now expecting sales to be up high single digits.
Okay. And the drivers for aerials demand this year? Mainly replacement.
Yeah, primarily replacement demand from the big rental customers seems to be the main driver this year.
And potentially a similar cycle coming for MP.
They see potential for that, yeah. As the equipment fleets get older, you could see a sort of compounded replacement effect kick in for MP too.
Any potential green shoots internationally? You mentioned Europe was weak for MP.
Well, they did mention seeing some very early tentative positive signs in Germany's economy.
Which could help.
Could potentially benefit their material handling business, aerials, and the aggregates part of MP. But, and this is important, that potential upside is not baked into their current forecast yet. It's just an observation at this point.
Got it. One last thing on ESG, that strong Q1 margin. What drove it exactly?
It was a combination of things. Higher sales volume, record factory throughput, which helps absorb costs, favorable factory absorption in general, and also some early synergy benefits from the integration.
But you said it might moderate.
Right. Some of those benefits might have been a bit one-off, and they also plan to make investments to support future growth, which will impact margins a bit. So still strong, but maybe not quite 19.4% every quarter.
And the ESG backlog is solid.
Very solid. Represents about 8 months of production right now.
Any other noise in the quarter? Accounting stuff?
Yeah, there were about $10 million in purchase price accounting adjustments related to the ESG deal that flowed through in Q1.
And steel prices. Any worries there?
They said no material impact expected from North American steel inflation, mainly due to their sourcing contracts and hedging activities.
Okay, that covers a lot of ground. Which brings us to our favorite speculative segment.
Yes, the This Is Not Financial Advice segment.
All right, hit me with a trade idea based on all this.
Okay, purely hypothetically, right? You could consider a long position in teak.
The rationale.
The market might be, let's say, underappreciating how quickly those aerials margins could snap back in Q2. Seasonal demand kicks in, the production issues are resolved.
And management sounds confident about hitting double digits again.
Exactly. Even with those tariff headwinds, which seem more weighted to Q3 and Q4 for aerials anyway, so maybe there's upside surprise potential in Q2 margins.
Plus the ES stability.
Right. You've got that really solid base from environmental solutions, which is performing great. And then, potential wild card if things do start looking up in Europe, maybe sooner than expected, that could give an extra boost, especially to MP looking out towards 2026.
So it's a bet on execution, seasonal strength, and maybe a bit of overlooking by the market.
Sort of, yeah. A calculated thought experiment based on their operational plans and how the market dynamics might play out. But again, absolutely not financial advice.
Naturally. Okay, that wraps up our deep dive into the TTEC Q1 2025 earnings call. We've hit the results, the strategy, the outlook.
Yeah, hopefully that gives you a clearer picture of where things stand. Lots of moving parts, as always.
Absolutely. And remember, this is just our analysis based on the call. Always do your own homework before making any decisions.
We're curious what you think, though. What jumped out at you from these results? How do you see TTEC handling the tariffs or integrating ESG?
Let us know your thoughts. We'll be back soon with another earnings breakdown. Thanks for tuning in to Talk Tickers.